right, let me get your attention. This is week 5, and we're moving through the semester rather rapidly. Next week will be the last of the first set of presentations this semester for the AIM class of 2023. Today we only have 3 that will be conducted here in the classroom because there was a conflict with one of our lacrosse players who presented earlier today. So there'll be 3. Interestingly, this week, of the 4 stocks, we have 3 information technology companies. So you'll get your share of tech. So again, welcome everyone. Nice turnout here today. We look forward to your Q&A. Dr. Wall, good to see you.
Good to see you as well. This is great. We can ask the classic question why your stock's better than the others, of course, right? So without further ado, welcome to the juniors and their first pitch is up here. And so I think we're going to start with what, Ryan? Yep. Yeti Holdings. So Ryan, come on down. For those not in the know, Ryan has been working diligently on his pick for Yeti. So he's going to start us off with telling us how he chose the stock that he's pitching today. Give us a little bit, just a quick background, because we got some visitors on how he came about it, why it might be an interesting pick, very briefly. And then if there's one lingering question out there you either feel it keeps getting asked or you didn't have a chance to answer. And then we'll open the floor to Q&A. So take us away, please.
How's it going, everyone? I'm Brian Kreie. I'm a junior in the AIM program here at Marquette. The company I'm pitching today is Yeti Holdings Incorporated. Yeti, they make coolers and drinkware that's insulated. One of the questions that came up on D2L was about my PEG ratio that I used. I didn't put the numbers in the boxes, but Yeti's was 1.57, Helen of Troy was 2.2, Newell was 2.4, Vista Outdoors was 1.69, and Columbia was 1.88 to get a weighted average of 2.14. That's not in the box. Some questions that came up on D2L was my direct-to-consumer percentage compared to competitors. Yeti's is 60%, and the nearest competitor was Columbia at 52%, and everyone else was below 25%. Another question was about supply chain. Management said that they would resolve their supply chain issues by Q3 2022. They did have some slowdowns because of COVID and stuff like that. And gross profit decreased 190 bids because of that. And then another question was about my driver number 2, which is their premium pricing. So as you know, Yeti has pretty expensive products, but if you compare the price consumers pay to repurchase cheaper products compared to the Yeti product that's built to last, Yeti product starts to make sense. Okay, with that, I'll open up to questions.
I'm going to go right back to your second driver, because that's an important assumption. The ability to charge a premium price makes the margins higher and makes this very attractive. I don't deny that they had a moat. You're assuming that this moat and this premium pricing will continue.
Yes.
Convince me and your peers of that.
So Yeti's kind of developed into more of a lifestyle brand. People are kind of buying into their lifestyle of durability and kind of environmentally friendly as well. And that's kind of what sets them apart from competitors is their whole lifestyle around what they do. And customers know that Yeti doesn't make any sacrifices in developing their products, and they use the highest quality material as a manufacturing process, so that's why their prices go up, but it's for a good reason.
All right. Did you look into any reviews of Yeti compared to its peers on some of those durability and quality aspects of it, like how they compare in a rating on Google or Amazon?
Yeah, so I did look at that, and a lot of their competitors would complain that the water bottles would be dented and stuff like that, and Yetis were not. And then some of their coolers, Yeti outperformed their competitors in like the amount of time their drinks stayed cold. So a lot of competitors said that they were going to end up switching to Yeti because they knew they had the highest quality products.
So who's their number one competitor?
So they, the number one competitor is probably RTIC. They are not public though, but they offer a lot of the same products, and they try to undercut Yeti's pricing, but have had little success growing their business. And then public companies would be like Igloo, Coleman coolers, and then for water bottles, I have it in here. For water bottles, Hydro Flask, Brewmate, and Camelback. but those aren't insulated like Yetis are, so that's what sets Yeti apart as well.
Yeah, so quick question for you. So I saw that about last week, Yeti pulled out all their merchandise from Lowe's. And I saw that they're gonna open up like a bunch of stores in the future. Do you have like any idea what when the timeline for that is gonna be?
Yeah, so Yeti pulled their products from Lowe's because they believe they could better focus their inventory elsewhere. They just weren't selling as well as where they thought other places could, so they pulled their inventory from Lowe's. There was nothing against Lowe's, they just thought that they could better place their inventory elsewhere. And this was because they were trying to offset the costs from increased shipping costs and stuff like that during the pandemic. So they've been more conscious as where they place their inventory to try and drive up their profits.
This is kind of qualitative. It might be a softball, but Yeti was pitched about a year from now, and so like we didn't buy it. So how has the story changed? What do you think differently about it? What's happened in the past year?
Yeah, so back then it was trading at $80. Now it's at $60, which is one of the things. I know in Mike's peer review, I know Mike pitched it. He messed up his relative valuation a little bit and used Canada Goose as a peer. And also, I think Yeti started to realize kind of who they are as a company and kind of what they value, and they've kind of pushed that more into their products. So I think since they know what they are, they can better market themselves.
So it's just trading more at a discount, you're saying?
Yeah, that's it.
Over here. Okay. You're trying to call on Rishi, got it. Alright, so my question's going to align with both. Actually, I'll just go to Professor Walker.
Tell me if your relative valuation rely heavily on the DCF and the PE to growth rate, but yet I don't have any data in the peer group box for your PE to growth rate.
As of the beginning.
Yeah.
I didn't know that again.
Oh, sorry, apologies. So can you give me just a range of PE to growth rates for your comps?
Yeah, so it's 1.69 to 2.2, and Yeti's is at 1.57.
Thank you.
So your PEG ratio that you used, and I'm going to double down in the same area here. You base that growth rate on next year, this year, which growth?
So that's EPS growth for the next 5 years.
Okay, so you used a 5-year PEG going
Yes.
forward for
Correct.
you and all your counts?
Yes.
And how did you come up with that growth rate?
Just use the CAGR.
Yeah, but I mean, you said for the next 5 years.
Yeah.
So where'd you get that from? Did you forecast for all
Yeah,
the comps?
I forecasted for Yeti, and then for the comps, I used FactSet estimations.
Okay, and did you by chance run FactSet estimations against your own to see where you fell in line on your growth rates?
I was pretty close, yeah.
Okay, so you're pretty much similar.
Mhm. So I think Vista Outdoors was a little bit less growth. They gave them the benefit of the doubt with GDP and stuff like that.
Okay, no, I just wanted to do a quick spot check on the word. So really, because that's where it comes down to for me. If you're right about growth continuing, even though it's slowing, then you're fine. But if you're not, gosh, your PE, your EV to EBITDAs are damning, right? This thing's going to drop 50%.
Yeah.
So, fair point. Next question. Yep.
Yeah, when we get you to EBITDA on your valuation, you said you used it 9.72 times. Your boxy 11.72. What's the disparity between those two? And maybe walk through your terminal growth rate with me. Why'd you use 1.75 when your revenue's growing at 10.5%?
So first for EV to EBITDA, the 9.72 was a weighted average, and the 11 whatever was just a straight average. So my bad on that. And then your second question, remind me again.
Your revenue's growing at terminal growth rate at 10.5. Why'd you use 1.75?
I was just being conservative with that number.
Okay, fair enough.
Other questions?
I think going back to the strategy, they seem to be going more DTC than selling to retailers, which keep the size below. Are they actually building retail stores in lieu of selling through Lowe's and so forth?
No, they're not building their own retail stores. They're just going through other people here. I can read you off the list of who they do go with. Their wholesalers include Ace Hardware, Dick's Sporting Goods, REI, Walmart, Bass Pro Shops, and Shields are kind of their top wholesalers.
Did Lowe's pick up a secondary branch?
I did not look into that.
Dr. Krause.
Two quick question, then a comment. The question is, are you concerned about the short interest at 7%?
Not
And do you know some of the history of short interest with this stock at all?
Yeah, so at the beginning of the month, there was kind of a big sell-off of them just because they thought there was some high value there, and a bunch of institutional investors swooped in and kind of picked up some slack there.
You know, this is maybe one of the highest ROEs we've seen in a long time. That's not a typo, right? 52%. ROA's outstanding is whatever that is, 25%. Now, they have some debt in their capital structure, but that's quite a bit of a jump from ROA to ROE.
Yeah.
What are their other long-term liabilities that might not be seen as long-term debt?
So it's actually mainly current liabilities from a lot of their freight costs, contract liabilities, advertising and marketing, and operating leases that have all went up a significant amount this past year, which drove up ROE.
Okay, thank you.
All right. Thank you.
Anything else? Start talking yet?
Good time.
Well, let's talk about myself. What would you replace in the portfolio?
Probably Ethan Allen, which is a furniture company.
What do you think of that, Manny?
That's not me, that's
That's
Maddie.
Maddie Ogden.
Yeah.
Other ones. Those are the same with Maddie. Other Maddie.
Yeah, let me come up- I don't mind saying that, Ethan, on the wall, though.
All right, I'm good.
Yep. Thank you very much.
All right, Richard, our next victim volunteer, come on down. We cleared out even more time for you. So same thing, right? Richard, if you could walk us through how you found this stock, and then maybe there's screening criteria, maybe a little bit about what it does, it's real brief for our visitors. And then if there's one or two either lingering questions or an issue you think you'd like to address, then we'll get things rolling. Thanks.
All right, thank you. My name is Richard Zaro. I'm a junior. I cover domestic information technology, and I'm pitching Knowles Corporation. Knowles is a market leader and a global provider of microacoustic, audio processing, and precision device solutions. They serve the consumer electronics, communications, medtech, defense, EV, and industrial markets. And then in my screening process, I used Finviz and FactSet. I wanted to find a company that had a strong balance sheet and strong financials, something that was established, and a lot of low debt and not too much volatility within the company. When I came across KN, I thought they had a lot of room for more sales growth and being able to adapt to the growing industries. I like their management. Their CEO has a lot of industry experience within the audio and precision device industries. He's been with the company for over 20 years now. And I like that their focus was on more high-end versus just more lower-end products. And then just one of the common questions that I got was my terminal growth rate. I reran my model with a 2.5% terminal growth rate, and then that gave me an intrinsic value of 22 for my DCF, and then combining that with my relative valuations, that still gave me a 25% upside.
All right, Dr. Kruszeski,
Yeah,
please, you get the next one.
You're
Yep.
for the freshman after this, okay? I kind of want to go back to your WAC. Have they issued any debt recently?
They have, in 2021, they issued bonds at 3.25%.
Okay. And that's not a big percent at all of the whole company. A beta, 0.77. We usually don't see tech stocks with a beta of 0.77. Any thoughts as to why that might be that number? Are you comfortable with that number?
I am comfortable with that. They're a very long and established company. They also have very little outstanding debt. And they haven't had any inability to pay their debts in the past.
Take us away.
I was gonna ask about the beta, so.
Okay, well, you still can. Piggyback, did you compute your own beta?
I did not know I used a price set.
So did you do any other triangulation with beta? You said you're comfortable. Usually that means you did more than one method. Did you check any other sources? Did you do any differences?
I did check other sources, just basically like Yahoo Finance and
What do Yahoo Finance have?
the same 3.77.
Okay. Next up.
I'll go back to this. Oh, did you ask your question?
I was gonna ask about the beta.
Oh, you were, okay.
Yeah.
Great minds think alike.
You guys are old boys.
Audio company, 1946. But yeah, when you included their list of clients or customers, it was pretty impressive. What are they making for, say, Apple or some of the other major customers?
Over 50% of the revenue is in the MEMS microphones and audio processing. They make the just little microphones that go in all your smartphones and smart devices, all the Internet of Things devices also. Just little tiny micro acoustic devices that go in pretty much everything nowadays.
Yep.
You said you ran a 2.5 sensitivity, but what about like 1.5, 1.75? You know,
Under the terminal growth rate?
Yeah.
I haven't run that actually.
Well, we can imply, right? You ran 3.5 originally, it looks like. Let's do some quick back of the pocket math. And you were coming up with what for your value?
3.5 was 28.
28, $28, and now you ran a 2.5 and got to what?
21.78.
So we dropped about $7. So all things being equal, would be 14 or 15 bucks. So the query again, I think, would be: you realize two things. One, what's the problem with your 3.5? We'll do a teaching moment.
It's a little too high. It's
Why?
greater than the GDP.
Yeah, and a 2.5 is usually reserved for the most aggressive growth situations we have. You just pitched me something that's got a low beta, very old, very stable. I'm not seeing growth rates of 50 or 60 or 80%. So I'm thinking 2.5 isn't justifiable. So I would greatly appreciate it if you go back and run your beta, go run your terminal growth at 1.25 or 1.5, and retell us what it's worth. I fear it's going to knock it down close to current values, but that would be a more appropriate use of a DCF. Come see me in the future before you do this. That's Walker.
What's your thought process between using EV to EBIT, EV to sales and price to sales multiples? They came up with almost exactly the same answer. I'm just curious why you chose two of the nearly the same multiples to do your relative value.
I chose EV to sales because it took into account the higher price value, the low debt the company had. And then price to sales, I chose that just because of the high revenue growth.
But the debt level of the company is relatively unlevered or heavily, what do you say?
Very unlevered.
Unlevered. Okay, that's why they multiples on the same.
And it's the same thing. Generally speaking, when you use to sales type numbers, you're looking for something that's in the mid-teens or 20s. If you're gonna, especially if you're gonna double up, you're pitching as something that's declining towards 12. You're telling me it's really stable. I'm not sure your methods match up. Your logic matches up with your story in terms of choosing two methods. But you should counter me right now and say, with great respect, and I'll pitch in because it's your first pitch. Dr. Wall, if I used a PE, I'd still be really cheap. Yeah, fair point. I'll argue with myself. Yeah, that's.
Okay, so I see that one of your risks is like, especially with the limited number of customers. I'm sorry. Do they have any contracts with their customers, and if so, like when do they end? And do you see any like competitors like swooping in?
To address the competitors, not really. The only other really comparable brands focus more on like lower end devices, kind of more like mass produced type things. And then they don't really have contracts or like anything temporary. It's more like long standing because they're really the only supplier of what they produce. So I still would assume that Apple continues to buy the products for the future.
Tom has a question.
Hey, Richie, so I saw in 2021 your company has about a 13.5% operating margin. You have about 10% of expansion. You hit it about 24% in 2024. Can you defend the roughly like 1,000 bits of expansion there?
In the
2024.
Yeah, your margin really takes off.
yeah, that's a lot of because of some of their acquisitions. There's a lot of the pricing when it just with those acquisitions, they're able to keep a lot of their costs low. When buying from a third party, there's a significant premium that they pay. But that, in addition to their manufacturing efficiency increases. It allows them to decrease their costs while still being able to charge the same amount that they do. Yeah, I think that's.
I guess just to follow up to that, so how's your margin been historically in regard to like, so you call them kind of acquisitions as margin expansion items, so you know what the margins of the acquisitions are and how much revenue they're contributing to your top line?
I do not know exactly. I can get back to you on that for the revenues of the acquisition.
Yep, Rishi. So how much of your growth is organic, and what's like from the acquisitions then?
Majority of the growth is organic. The acquisitions more so served as like a reducing costs and increasing their margins.
And you say that Proverbs expect to increase 3% year over year for the forecasted figures. Where is that exactly coming from?
Should we read that again?
You're saying your first driver, Proverbs expect to increase for 3% year over year over the previous forecasted figures. Where is that kind of coming from?
Oh, it just increase efficiency within the manufacturing process.
Okay. Do they have some sort of distribution mode, these acquisitions that they're taking care of, or
Sorry, what was that?
like what? When you say manufacturing efficiencies, is it kind of with like, what do you mean by that?
It kind of, when they produce their products, they have to start in like small batches, and the cost for that, this initial costs are really high, and then with economies of scale, they're able to cut down a lot of that cost.
Okay.
Did they have any supply chain disruptions during the pandemic, and how did that affect margins?
They did. They had some issues getting with the semiconductor shortage, as well as just shipping and stuff like that. But they were able to find alternatives, and it didn't drastically affect the business.
Can you just go over your peer group? I see you have Texas Instruments in there at $158 billion market cap, kind of a bigger company. Just go over that.
Yeah, there's Texas Instruments getting a lot of precision devices as well. There's not really within my peers. They are like exactly what Knowles does. I kind of just found some that had a big portion of their business tied into what CAN does. Texas Instruments being the precision device manufacturers, but I'm sorry, did you just repeat the question?
That's fine.
Okay, last question. Really, Itasca, Illinois? I mean, I'm a fan of the Upper Midwest. Do they assemble there? I mean,
It's a Chicago suburb.
do they manufacture? I mean, seriously,
Yeah,
do
yeah,
they
yeah.
manufacture?
Absolutely.
Or is this made in China or Mexico or Vietnam? You know?
They have a couple, they have like 5 manufacturing facilities across the globe. I know one in China, there's a few in the US and then other countries, I believe.
So that supply chain risk is therefore a very real risk.
Yeah.
Yeah.
Right.
Okay.
And then one thing I appreciate you doing for the group also, in addition to running the DCF at like a 1.25, 1.5 growth rate, do your EV to sales piece, price to sales, since you chose those two, but since you just said TI doesn't really fit, it just kind of got slapped in there, run it without it, because I'm worried that there's almost no upside in the stock. If like remove Texas Instruments, it sure looks to me like all your upside's being driven by it. Okay. So if you could run that and get back to us, I'd appreciate it. Thanks.
Thanks, Richie.
And last but not least, Owen's ready to roll.
Thank you, Dr. Wall.
No, yeah, same thing, Owen. If you could talk us through how you came about Insight, maybe a screener or two, and then for the family that's here, a quick background on what it is, and then one big key issue.
Yeah, of course.
Thanks.
So just to go on my screen a little bit, I was looking for a high growth company with relatively low debt and a good management team, and then kind of like a story that can fit into kind of where we're at, COVID aside, going forward, something that can serve businesses beyond just COVID. So to go on my kind of like my pressing questions out there, the first thing I want to address is my WAC. So the overall like WAC didn't change drastically, but the composition of it did slightly. So what I figured out was their interest expense most of it is tied up in accounts payable and financing facilities. So their actual income or interest expense they pay yearly, a lot of it's tied to their these like financing facilities. So when I ran back the numbers to find the interest like tied directly to their long-term debt, it was a lot lower than the cost of debt prior to it. So after talking to Dr. Wall, we like kind of just overrid their cost of debt to make it more representative of what they're actually paying to their long-term debt. So it was originally at around 8%. I put it at 4% and then added a 25 bips risk premium. So that's on my WAC. And then in terms of a question on NSIT, kind of just like where they fall like within the market, they are a reseller of IT software and hardware. So the best way I can put it is think like an e-commerce Best Buy. And another thing I've been saying is like if their Geek Squad was a Geek Army. So it's like kind of like a revamped digital Best Buy. So going on that, I'd be happy to answer the questions.
Questions from the crowd?
We're gonna wait you out here. We need some questions.
Oh, we'll okay. Ask.
Yeah, so can you touch on your company's backlog of production and you see that as a risk?
Yeah, so since fiscal year 20, they've had considerable backlog. Management has been extremely vague in quantifying this. So after going back to like 6 quarters of earnings, they keep saying words like elevated, significant, record-setting, really no direction. I reached out to their IR rep and nothing again. I don't think I wasn't really high in their totem pole of information.
They responded though.
No, they did respond, but
They wouldn't answer.
nothing. But so to account for that, I shaped about like 2.5% of growth going forward on their hardware, which is mainly what the backlog's coming from.
Yeah, so you said that they've been growing sales at a CAGR of 12% and even a CAGR of 14.8%, and your growth rates are way lower. Does that kind of mean the story's kind of over for this company, that the best days are kind of behind them?
No, I'm just being conservative considering COVID. So prior to fiscal year 20, they've been growing at like 9% yearly. I tailed that back a little bit. It's like around 7.5, I think. So I didn't want to be overly aggressive considering like a lot of their growth was due to COVID, but I still think they're a company that can perform beyond. So I tailored it back a little bit, but they're still growing, and that's kind of going into their margins.
So what is it if you don't tailor it back then?
If I don't,
If you don't pull back?
well, a lot of it was because of the backlog. I shaved like a considerable amount of
Okay.
revenue off.
The company just makes a statement that they have significant backlog and it's double last year, but they won't tell you how much. which is
If anything,
scary.
really, I was just being like,
Yep. So I told them to take off
Yeah.
lunch.
Fair enough.
fair case of it.
Joe,
Yeah, just regarding your first person partnerships, what do those partnerships kind of look like? What do you have contracts? Are those long-term, short-term? What do they look like?
Yeah. So, their top partners are. Sorry, I'm gonna get to it. So the top partners are Microsoft, TD SYNNEX, Ingram, Micro, Dell, and Cisco Systems, which do account for 50% of their sales. Management's come out and said that of the other top partners, the only one if they lost would be Microsoft, and that would substantially hurt them. The other partners are interchangeable, but I don't pose it as a huge risk considering they've won awards with all these partners for the past 5 years. So like they're mutually benefiting off each other. I don't see it as a huge risk.
Is there any competitors that are looking that Microsoft would switch over to a competitor? Or how does
Of
that
the of like some of their direct comps, they have Microsoft, but they're not as competent as NSIT is in their products.
Professor Walker's next.
How do you, I look at the margins here, 3.5, 3.5, 3.6, and just say, it's almost like it's not even, kind of a retailer margin. So it's very low and low single digit. I mean, where's the value added here in this company? Is something I'm missing? I see that they're moving to the software as a service that would imply, potentially higher margins. But I don't. Is there something going on in the mix? I'm not gathering the story here. What the true drivers are to seeing margin expansion.
Yeah, so the margin expansions in their gross margin expansion with their product mix. So they're deploying more services coming into fiscal year 2022, which carry lower margins with hardware increases. So it's causing the shift. They have a considerable amount of SG&A and COGS. So their margins are already like super slim. So that 3.5 growth is like actually pretty substantial.
Yeah, because they're a reseller.
Yeah, their
And they
margins are
also
pretty
do
slow.
some value-added
Yeah.
consulting
Yeah.
too. That's a risk for them hiring people, isn't it? Have there been issues about their ability to hire competent technical people in consultative roles?
No, so they acquired PCM, which is a French consulting firm, like 2 years ago, which added like 3,000 consultants and technicians to their overall employee structure. I think they're like I said, their SG&A accounts for like 12% of their costs. So again, they have a lot of, that's kind of like their manpower, but yeah, I don't think they have any issues with that.
I had a question about their sourcing strategy. Like, who exactly are they sourcing their products from, and do they have any contracts or anything like that that can hedge them from like their vendors potentially like raising prices on them?
Yeah, so they don't have, their model is not a contracting, it's called a partner funding. So essentially, it's volume driven. Their top partners supply them with their respective hardware and software, and then based on the volume for the given year, they kind of like tweak their next fiscal year. I tried to look into contracts, try to find any sort of number. It's extremely vague. They use a lot of words like strong, like elevated, like that type of stuff. But even finding like a retention rate, I couldn't find anything on that. But no, they've had pretty good success with Microsoft, specifically in Cisco systems.
So thanks.
So help me get comfortable with best deal or best deal here. Because as I look at your comp method choices, that's great. I appreciate you stripped out the one, but this is driving most of your upside from a comp basis. So can you help me understand why they're a good choice and why they should indeed cause me to have optimism in this company?
Yeah, well, for starters, Insight, 2 or 3 of their most direct competitors are private. So to start, Insight's comps were kind of a toss-up. So
I'm most interested in your answer to this one.
No, yeah.
Right.
So I included Bechtel because of their European presence. So they're a German company. I wanted some international comps because 20% of their revenue is coming from Europe. So my thought process behind eliminating one and not both was, although they're driving up their ratios, if I were to take out NetScout and Bechtel, that would be only going against 3 comps, which I thought was a little low. So
let me rephrase though. I appreciate all of that. Why should I be comfortable with Bechtel as being a good comp for this company? Because if it's not included, suddenly there's no upside. So help me get comfortable with that being a good choice. Yeah.
They essentially do what Insight does just in Germany. So they sell hardware, software solutions. They're pretty much an identical company just in Germany.
Perfect. Rishi.
Insiders have been selling your shares massively over the past month. Can you make a comment on that?
Yeah, so I think August brought that up in D12. That's a pretty regular thing. That's like a pretty regular thing. Their insiders sell off shares like pretty regularly. Their Brian has sold like 47 transactions in the past 10 years. So like that wasn't necessarily an anomaly. That's pretty regular.
You've had 2 investors sell shares in the past 5 days as well. You had 2 investors sell shares in the past 5 days as well. I think James Henderson Group sold 4,000 shares. I don't know, last Monday.
Yeah, I mean their price is very volatile right now. I've also seen it. I've tracked a bunch of other groups buying a bunch of shares, so I think it's volatility right now.
Okay.
Their share price is up $6 in the past 2 weeks, and then it's down. I just think it's volatility.
Okay.
Sure.
Kind of continue off of that. Do you see who was your main short interest?
Yeah, so this is another thing I discovered yesterday with Dr. Wall. So, kind of going back to their debt, they have convertibles at a rate of 0.75. So, after looking into it more, we think it's like a hedging move where people are buying their convertible debt at a super low rate and then shorting Insight as like a hedge. And I did look into that. A lot of their holders are top hedge funds, and it doesn't make sense that their short interest would be this high right now. So that's my speculation.
Any last questions?
All right.
All right.
So-
Still alive.
All right, so what you did miss this morning at 9 o'clock, if you weren't here, was Max presenting Domo, a cloud database artificial intelligence-based company. So those were the 4 stocks that were pitched.
Absolutely.
Those of you who presented, coming up right afterwards, we'll talk about your potential buy-sell. The process is going to be, again, buy-sell recommendations go out tomorrow morning along with the ballot. Ballots due by 9 o'clock on Sunday.
We
Right.
appreciate the dedication of the senior class in breaking up a very important function to share some time with us before they return to their regularly scheduled activity.
All right. Andy, have a good weekend.
Going back.
21.
21, come with us.